If you're thinking about buying your first home, there's a lot of questions that I'm sure you have. And this presentation and video was made just for you to walk you through and give you an overview of the process, things you should be aware of, and things to plan for in your home journey. So I'm going to go ahead and share some slides with you and walk you through exactly some questions you should be asking yourself, as well as things that you absolutely must know if you're thinking about purchasing a home. All right, so let's dive right in here. Now, whenever you're thinking about buying a house, first of all, my name is Jeremy Forcier, and I'm honored to be putting this together for you. If you have any questions about anything that's covered today, just feel free to reach directly out to me via phone or via email, as you can see here on the screen. Now, something that is really important when you're going to buy a home or you're thinking about it is to not take it too serious and put too much pressure on yourself at the beginning. So ask lots of questions, have fun with the process, because buying a home should be exciting. Things that I'm going to go over today are renting versus owning, bonuses to buying versus not owning a house, how to assess and plan both the mental and emotional part of buying a house, financials and what you need to prepare and what you should be looking for, and then, of course, the home buyer roadmap. So let's talk about renting versus buying. Now, bonuses to purchasing and buying a house, of course, you have tax benefits. You can write off certain portions of your property taxes that you pay, as well as the interest that you pay on the loan, versus you cannot do that when you rent a home. Building equity and wealth over time, the value of the property that you purchase will increase over time, but you're also paying down a loan monthly. So you're increasing equity and increasing your net worth over time by simply just paying your home loan versus paying rent. Of course, pride of home ownership, having a family and stability are things that we're going to go over as well, and being in control of your environment, whether that's pets, whether that's how you want to decorate the place, if you want to build something. When you own a property, it truly is yours, and you can do whatever you want to it. Now, the mental versus emotional. This is, something that people I think underestimate when they're thinking about buying a house, but you need to learn to assess a plan. And the earlier you start, thinking about purchasing a house before you just go out there and go, I want to buy a house and start making offers, the better. So we're going to go over mental, emotional, as well as financial things that you absolutely need to have put in place to make sure you have a good experience. So here are some really simple things that I ask my clients to always ask themselves, like, what's your why? And what I mean by that is, why do you think you want to purchase a house? Really understanding why you want to do it is going to make it more clear for when the right time is for you. Like, is rent on the rise? Does your rent payment keep going up? Are you tired of moving every 12 months or 24 months when your landlord feels like they want to increase the rent, or they want to sell the property, etc.? Are you growing your family? Are you relocating for work? Is building equity important to you, building your net worth over time? Now, a second question that's really important to ask yourself is, how long do you plan on staying in the home? I always ask this question to people that are thinking about purchasing, because it's a myth that you just buy a house and then you can sell it whenever you want and you automatically make money. You should really be thinking about, am I going to be here for at least 3 to 5 years in this house? What's my time frame look like on living in the area that I'm at right now? Another question that's great is, like, are you purchasing with someone else? Are you purchasing with a boyfriend or a girlfriend or a partner? Do you see yourself like really being with them for a long period of time if you're going to buy a house with them? And does that make sense for you? Have you already proven a track record together of paying bills together, etc.? And then the last question is always, how much work am I willing to put in a home? When people are looking at homes, especially for the first house, sometimes we get attracted to what looks like quote unquote great deals. But the great deals usually are just because there's stuff that's really, really wrong with the house. So you have to ask yourself, like, am I willing to look at a fixer? How much is that going to cost me in money? Or am I handy and can I fix up a property myself? And how much time am I willing and work am I willing to put into that? If you ask yourself these simple questions up front, you'll gain some clarity as to why you're purchasing and what your risk tolerance is going to be depending on the type of house that you're looking at. Now, when this slide says financially and think like a lender, this is what's important to know that I'm going to go over in detail, like credit. We need to make sure that our credit score is in a good position. Now, I will tell you that most people think that their credit score is far worse than it actually is. So 580 is the minimum credit score we need in order to purchase a home. And it's very, very rare that I ever run a credit report and see a number below 580. Now, even if your number was below 580 or we want to maximize it to get a higher credit score, I can help you with that as well. I can show you exactly how to boost your credit, how we can fix things if there's anything that's impacting your credit score, as well as take any information that may be fraudulent off of your credit report. Now, the second thing on here says MSN, and that stands for monthly survival number. So that's going to be, basically your bills every single month outside of what your rent is and mortgage is. It's really important to create a budget around your life and how much it actually costs you to live and the things that you like to do in your free time as well. Cash, we'll be going over a savings plan, setting aside 6 months of whatever your monthly survival number is. So if it costs you $2,000 a month to live outside of your rent and your mortgage payment, like maybe you need to set aside $24,000 for an emergency fund. You can also use that towards your down payment. So understanding like say cash savings is really important in figuring out how much cash do you have to put down or are you willing to put down to purchase a house. Income will go over on how does it look like with employment and income and how long do I need to be on a job, for example, things like that that lenders look at to create stability in the approval process. And then debt to income ratios. I'll go over this in detail because it's not what you think. And a lot of people think, oh, I have debt. There's no way I can buy a house. It's very different. They shouldn't actually even call it debt to income ratio, but I'll go through that on the slides ahead. So when we take a look at credit scores, I'm not going to spend too much time on it because it's not the number one, thing I would be focused on, quite frankly. So, but the higher the credit score, right, the lower the cost of the loan. So the higher your credit score, the lower the cost of your loan. The easiest way to improve your credit score is just to make sure that you always pay your bills on time. That's the number one driving force on credit score models is they just look for a history of payments and are you paying on time? That shows financial responsibility and it also will boost your credit score. Don't apply for too many new credit cards. Like people that are applying for credit cards frequently because you get 0% interest, for example, that actually lowers your credit score if you have too many new credit cards that you're opening on a frequent basis. Trying not to max out your credit cards also boosts your score. So if you have like a $5,000 limit, you want to try to keep that like at around let's call it $2,500 or $3,000 on a use basis. So showing that you can manage credit and not max it out is also going to improve your score. And then the number one mistake that people make around credit, the last tip here, is if you've had a credit card for a really long time and you don't use it anymore, don't close the account. By simply keeping it open, the longer the history that it shows that you have credit available to you, the more positive impact that has on your score. Now, the reason why it's so important to look at your credit as well outside of just qualifying for a loan is that 1 out of 5 Americans find errors on their credit reports. So we'll take a look at that with you and point out anything that could look fraudulent. Could like I had it happen to me. I applied for a mortgage about 10 years ago or so. And I remember they asked me about this collection account from Xfinity Cable based on this property in San Francisco. And I've never lived in San Francisco. And it turned out someone had opened multiple accounts using my identity. So we can take a look at things like that and get them corrected and taken off. So it's very important to look at what's impacting your credit score and also to make sure that all of the information is accurate. Now, monthly survival number here. This is really important is we don't spend enough time thinking about budgeting and thinking about how much money we actually spend on a monthly basis. So if you'd like a copy of a simple budgeting form, it looks very similar to this, but you should figure out how much am I paying right now in rent? How much do I have in auto loans per month? What about my credit card payments? Do I have any student loans? Home utilities like PG&E, electric, gas, phone, internet, cable. How much am I spending on groceries per month or eating out? These are all things that need to be taken into consideration so that you can figure out what a good monthly budget is going to be for yourself when you're purchasing a home. Now, as far as cash goes, like this comes down to like down payment and different loan programs that are available. So in general, you can put as little as 3% down on a home purchase. So that means that you can put a 3% down payment up to a loan amount of $766,000. So if you were going to buy a $400,000 home, the minimum amount down you would need access to would be $12,000. A $500,000 home would be $15,000. 600 would be 18, et cetera, et cetera. So 3% down on a conventional loan. Okay, so this is a national insured loan. 3% is the minimum down payment. Now, something that's important to note here on this slide, you'll see that there's a column that says gift funds. So 100% of your down payment, whether you're putting 3% down, 20% down, or 50% down, can be gifted from a family member. So that means that if you don't have all the savings ready, but you do have access to the money from a family member, you can actually use that for your down payment. It counts 100% towards the initial investment. Now, the second column that I show here says 0 to 3.5% down. So government loans, which is FHA, the Fair Housing Authority, VA, which is if you're a veteran, and USDA, these loan programs allow 0% down to 3.5% down. So there are down payment assistance loans for first-time homebuyers. If you don't have the ability to make a down payment, these are the loan programs that we would look at together. 100% of the funds, by the way, again, on these loan programs can be gifts as well. And then the third category that I'm showing you here is jumbo. So a jumbo loan just means that it's over whatever the conforming loan limit is, and that is different in each county. So if you have questions about that, you can let me know. Jumbo loans go up to $5 million. Now, when you're calculating your payment, like remember to include closing costs, which I'm going to go over next. So you have your down payment, and then you also have closing costs. And closing costs typically are going to be 2 to 5% of whatever the purchase price is. So we always tell everyone, hey, prepare for 3% closing cost and a minimum 3% down payment. So if you were going to buy a $500,000 home, you would be thinking that your closing cost will not exceed about $15,000. Now, if you want a detailed, itemized scenario for exactly what you're looking at purchase price wise, you can let me know and we can always create one for you and give you a personal presentation, which exactly how much would be due. Now, as a note here as well is that sellers, okay, as part of your offer, so when you're buying, part of your offer to a seller of a home could include a credit for the closing cost. So technically, you could come in with just a down payment and you could ask for the seller as part of your negotiation to pay for the closing cost. If you have more questions about that, please reach out to me directly. Now, income. This is really, really important. So when lenders are looking at income, and what you need to be thinking about as well with your income is we look for consistency. So I'll give you a great example. Like on a W-2, if you're a W-2 employee, we're going to want to collect a W-2 from you as well as your last two pay stubs just to see, is your salary the same, right? Are you salaried or are you paid hourly? If you're paid hourly, do you have overtime? How much overtime do you average? So we're looking at a consistent earning history whenever we're taking a look at any W-2 borrowers, as well as if you're self-employed, it's a little bit different. When you're self-employed, we're going to take 2 years of your tax returns and we're going to average that over 2 years because income can fluctuate greatly for self-employed individuals. We also have specialized products specifically for self-employed people where we can use bank statements for income over 12 months rather than just looking at the tax returns. So if you have questions about any of that stuff, please, please, please let me know. Now, I made a little joke in this, but it's not a joke, it's real. The bottom of this slide, you can see it says, hey, if you're going to change your job, like let us know. People get scared sometimes when they want to take a new job and they don't tell the lender. That's a huge mistake. You can absolutely change jobs during the process of thinking about buying a home, and we can still use the new income. We just need to know how you're going to be compensated. So even if you were going to change your job midway through the transaction, we can still deal with that only if we know, though. So if you are going to change jobs, all you have to do is let the lender know. You can let us know and we'll update everything, and it's really not a big deal. Now, debt to income ratios. Let's talk about this. So debt to income ratios has nothing to do with your actual debt that you have. And here's what I mean. Banks don't look at the amount of debt that you have. So if you had $10 million in debt between business loans, student loans, car loans, whatever it may be, if you owed $10 million, but your payment per month on that was just $1 a month, that's what the lender looks at. So debt to income ratios really has to do with how much is your monthly debt payments compared to your income. So it doesn't matter how much you owe. We just have to take into consideration what are the monthly payments on that debt and make sure we factor that in when we're qualifying you. So a simple rule of thumb would be to use 43% or less of what we want the mortgage payment to be when you're buying a house. We want that to be less than 43% max of your gross monthly income. So if you made $10,000 a month, we wouldn't want your mortgage payment to be more than $4,300 a month. Now, when you are thinking about getting qualified and trying to figure out budget, I want to point this out. There's a big difference between getting approved for whatever the max is that you can get approved for versus maybe what you feel comfortable paying on a monthly basis. So when you're getting pre-approved, it's really important to communicate with your lender on like, this is really our target budget payment. So then you can see what purchase price range you could be looking at. Because budgeting is objective, excuse me, and subjective. So I can objectively tell you what you're approved for, but subjectively, you have to pay that every single month. So you have to consider your lifestyle, vacations, eating out, all of those different items into your budget. And if you keep your debt to income ratio lower, which once again just means your payments percentage compared to your income, you are going to leave a lot more flexibility for yourself, and you're not going to feel so tight on a monthly basis. So we will always customize every single quote, presentation, loan number scenario for your specific needs. So what makes up monthly payments? So on a home loan, you have four different items that make up the monthly payment, and then there could be additional items depending on your down payment or the type of property that you're looking at. So let's just look at what the primary four are. You have your principal, okay? You have your interest, you have your property taxes, and you have your homeowner's insurance. So your homeowner's insurance covers anything in a financial loss in the event of property damage. So think like a fire in the house, fire insurance. So it protects anything within the home and outside of the home, the structure, etc. Property taxes. This is something that people miss all the time when they're looking online at payment calculators, is you have to make sure you're factoring in property taxes. How much are those going to be per year? The interest and principal is a very easy calculation, and I can show you exactly what that looks like for your specific scenario. Now, additional cost, mortgage insurance. So whenever you put less than 20% down, lenders require what's called mortgage insurance. And this protects the lender of loss caused by a default if you were to stop paying your mortgage on a government or a conventional loan. Now, mortgage insurance, I will say, number one, it's not a four-letter word. It's a three-letter acronym, PMI, private mortgage insurance. It's really, really cheap these days. Over the last 10 years, it is the only insurance that I know that has gone down by 70%. So if you have more questions about that, let me know. But don't be afraid of mortgage insurance. Always just look at the numbers and see, does it make sense for you to pay this on a monthly basis, and then make a good sound decision based on that. Homeowners association dues is the last thing. So if you're purchasing a condo or a townhouse that has what's called an HOA or a homeowners association, you have to take that into consideration of what that will do to your monthly payments, because they take care of things like water outside, common areas, if it has a pool, etc. And you want to make sure that that number is going to fit into your budget, because that's added on top of whatever your mortgage payment is. And those can vary pretty drastically. They can be as little as $75 a month, and some HOAs can be as much as $650 or $700 a month. So making sure that you know exactly what the HOA payment is on a property in advance is important for your qualification and your budgeting. Now, the people that you work with when you're purchasing a house, number one is the loan officer. That would be me, a real estate agent. So if you need a recommendation to a great real estate agent, please let me know. I work with the best of the best, and I'd be happy to connect you with them. They work on your behalf to find properties, give you a great education, show properties, write offers, and represent you in the transaction. An appraiser, an attorney we don't use in California, but if you're looking at this outside of California, there are some states that are attorney states that draw up the contracts. We'll go over a title company. They collect your funds and they hold them in a third-party account for buyer and seller and help facilitate the transfer of ownership from the seller to you as the new owner. A home inspector and an insurance agent. These are the critical people that you will need on your team, and I can introduce you to the best of the best in any of these categories if you want one. Now, meeting with your lender is important. And we recommend meeting with a lender as soon as possible. So if you're watching this and you want to buy a home next week, that's great. We can move really quickly, but really you want to plan in advance. That way you can come up with a great plan, you can execute it, and it takes a lot of pressure off. So typically, the typical buyer that we meet with isn't actually going to purchase until a minimum of 6 months in the future. Now, once again, if you are looking at this and going, no, I want to buy right now, we can do that too. But the further you can plan in advance, the better it will be for you. Now, there's a big difference between pre-qualifying and getting pre-approved. And a pre-qualification is just a simple calculation to see how much you can afford based on what you tell someone your income is, but we don't really have any supporting documentation of it. So it's a great first step to talk about what does affordability look like. What you really want to do, though, is focus on getting pre-approved. So a pre-approval is a document that we generate that supports your ability as a buyer to repay the mortgage that you're going to get. And it involves like a loan analysis of getting your W-2s, your tax returns if you're self-employed, your bank statement so that we can verify all this information. And a pre-approval letter is what's required in order for you to make an offer on a property. So it's really important to go through the pre-approval process. It takes all the stress out of buying a house if you do the work up front. This is something that can happen in as fast as 24 hours if you get all of the information that's needed, and it's really not as much as you think. So determining your budget, these are positives on the pre-approvals. Like with a pre-approval, we can estimate exactly what you're approved for, put it into the correct budget range, and then you can shop for the right homes in that budget. You're not out there just looking at any home wondering if you can qualify for it. You'll actually know. You'll get a greater buying power as well. You're going to stand out from other offers that maybe people aren't pre-approved yet, and that shows strength in your offers when you're purchasing a house. And it will avoid huge setbacks. If we can do the work, as I said up front, we can deal with any issues before you ever even write an offer on a property so that when you do find the right one, it'll be really smooth. It also is going to save you a bunch of time. So when you find the home of your dreams, you can lock your loan in earlier because you'll know exactly what you're qualified for, and we can close quicker. That's going to help you get offers accepted and make the stress level go down. Now, the following documents are what we're going to ask for, and I alluded to this earlier. We're going to ask for 30 days of paycheck stubs. If you are a W-2 employee, we want to collect a W-2, your last 2 pay stubs, okay? Now, the second one is tax returns. Now, this would be if you're self-employed. If you're self-employed, we are going to want to get your tax returns. Or if you own a bunch of investment properties, we're also going to want to get your tax returns so that we can calculate income from that correctly. Assets. So this would be 2 months of your most recent bank statements. So when I say bank statements, think checking, savings, 401k if you have one, any type of IRA accounts, and any other investment accounts. We want to see 2 months of your asset statements to make sure that we're in a good position to qualify and that we meet reserve requirements on certain types of products. We're also going to check your credit. So not only is this important to identify identity theft, like I said, if there's any work we need to do, but as a lender to pre-approve you, we do have to run an actual credit report. Now, I get this question all the time. Is this going to make my score go down? Is this going to make me not be able to qualify because my score is going to go down? The answer is no. We do what's called a soft pull credit report. So this is what's important to know about a soft pull credit report. Number one, it doesn't impact your score. Number two, it allows us to still look at all of your liabilities and make sure that they're correct. And number three is this doesn't allow the credit bureau to sell your information, which is critical because the credit bureaus, ironically, they will sell trigger lead data to other companies that will start cold calling you and getting spam calls. So we avoid all of that through our soft pull process. Now, After you've done all this and you've become pre-approved, that's when you're out there and you're looking for a home. And your agent, okay, your real estate agent you're going to be working with, is going to take a look at what are some cosmetic fixes with the house versus structural issues. Like, let's make sure that the property taxes are going to be calculated correctly on this. They can tell you about neighborhoods, different schools, crime rates, etc. So you can get a great idea of the neighborhood that you're looking to buy in. When you make an offer, your agent, real estate agent, is going to negotiate a price and schedule a home inspection for you. So they're going to let you know how much activity there is on the home. Is it going to be competitive, and come up with a great strategy to give you the best chance of having your offer accepted by the seller. Now, applying for a mortgage, because you've already gone through the pre-approval process, once you're in contract, we're literally just updating a couple of items. So we're updating pay stubs and bank statements. That's it. Those things are good for 120 days and then they expire, but your pre-approval doesn't expire. All we have to do is refresh that information, and it takes about 30 seconds. It's really, really, really simple. Do's and don'ts during the home buying process. Absolutely inform us of any changes of employment, compensation, anything that's changed for you from a financial standpoint. Always make sure to continue to pay your rent, mortgage, credit cards on time during the home buying process. It's critical. The last thing you would want to do is to become not pre-approved anymore because you missed two credit card payments, for example. Keep a paper trail of funds that you're moving around from accounts. This is something that we can help you with. And we advise our clients like, hey, don't transfer from account to account because we have to paper trail that. It's not a big deal to us, but it's a pain in the ass for you. So we want to make sure that you don't have to go through that frustrating documentation process. And we can tell you exactly where to send the funds via wire once you are in escrow on a house. Any changes in your finances at all, but also any changes just in your life is really important to communicate. If budget has changed for one reason or another, we want to know about that so that we can redo the numbers for you and make sure that we're still putting you in a loan that you feel comfortable with and you 100% know that you can pay and afford on a monthly basis. This one's my favorite too. If you have any travel plans during the application process, so during the escrow period when you're buying a house, please let us know. It's so important that we know where you're going to be because you're going to have to sign documents at the end of the escrow period. And if you're traveling, that's okay. We can plan around it. But we don't want to create stress and scramble if you're going on a last minute vacation and we didn't know about it. Things you absolutely shouldn't do. So the don'ts when you are buying a house is don't quit your job. Keep your job through the close of escrow. We do need to verify employment before we send the final funds to the title company so that we can give you your keys. Don't co-sign for any loans. For any car loans for kids or friends or anything like that during the buying process, because that could impact your debt to income ratios and it could impact your loan approval. If you don't transition from your current employer to self-employed, this is the one item where changing jobs does make a big difference. If you're a W-2 employee and you change your job to another W-2 position, even if it's not in the same line of work, that's fine. But if you go from a W-2 employee where you're getting paid hourly or salary, and then you transition to self-employed and you're going to start your own company, et cetera, you're not qualified any longer because we'll need 2 years of tax returns when you're self-employed to look at what you qualify for. So that's a big, big no-no. Don't apply for or close out any new credit cards in during the process. Like just literally keep everything as boring as possible once you have made an offer and you're in contract on a home. Um, don't max out your credit cards either. Like make sure that you're not using additional credit during that process and moving funds around transfer. I already went through that. That's something that you want to make sure that you absolutely avoid. Underwriting and appraisal. So let's talk about what an appraisal is. An appraisal is the bank, us, the mortgage company, we send out a third party appraiser that inspects the property, and they're going to make sure that the property is in good condition as well as that it's worth what it is you're actually paying for. So you have something called an appraisal contingency when you buy a house. This means that if you're buying a $500,000 home and we order an appraisal on it, if that appraisal comes back at 490,000, you can back out of the contract if you wanted to, with no harm or foul, no financial consequences to you, or you can renegotiate the purchase price down with the seller. So having an appraisal is important. It protects you, and we get one on every single loan that we do. So once we get the appraisal back and it's signed off, then we move to closing. So closing is a time to celebrate. That's when you're going to sign all the paperwork and you receive the keys to your new home. So just some simple tips in here on how to arrive prepared for that signing, as well as how the underwriting process works. If you have more questions about it, feel free to let me know. Now, the difference between a home inspection and a home appraisal, you'll also get a home inspection on the property when you were purchasing it to make sure that it's structurally sound. Okay, so this determines like the condition of the property that you're buying. Um, we're going to order an inspection after your offer has been accepted, and it costs approximately $200 to $400. Honestly, that's pretty low. It could be $250 to about $750. But it's really important to get a home inspection so that you know exactly what condition it's in, because there's always going to be something that needs to be fixed on every house, no matter what, and you need to know what you're getting into. Now, the home appraisal, as I said previously, determines the value of the home that you're buying. We'll order it when your loan is in underwriting. It's something we take care of, and the cost is approximately $450 to $600. Okay, that's not something that you pay upfront. It's something that you can pay at the closing, or you can pay via credit card, and that doesn't happen until you're actually in contract buying the home. Closing cost breakdown. This is something that you can study. If you want a personalized quote, like I said, I'm happy to itemize one out for you. But this goes over all the different things that make up the total closing cost. So origination fees, which are fees from a lender for the particular program that you're looking for. Title insurance fees, those are all third party, and they're really easy to predict. Prepaids would be like homeowners insurance. You pay for a year of that in advance when you purchase a house, or property taxes that are collected up front. Appraisal fees, which I went over previously, transfer taxes, those may be the responsibility of the seller or the buyer, depending on how you negotiate. Recording fees, points, and other fees. So take a look at this. If you have questions about it, you can let me know. I can make it really, really simple and easy to understand for you, and I'd be happy to do that. So that it concludes like the overview of buying a house, the things you should know. If you have questions, I definitely have answers. So I would love if you would reach out to me either via phone, or you can shoot me an email. We can always set up a time to chat and go over what your specific scenario entails and see where you stand right now and come up with a great plan for you to purchase a home in the future. Thank you so much for taking the time to watch this. I hope it added some value to your day, and I look forward to working with you. Take care.